don't think there's an audio.
All right. Hi, everyone. Thank you so much for attending this webinar, Angel Investing in Venture Capital 101. And I'm so delighted to be here. And I also want a special shout out to Equivesto, who has made this possible and made this event free for everyone. And so we have our marketing director from Equivesto on the call, Zulani. Hi, thank you so much. All right, I'm excited to be here. So let's get right into the presentation. Unfortunately, you won't get to see much of my lovely face because I have a whole deck. And if you all know me, I love slides. So, so I'm going to share the screen, and there'll be a lot of slides, but hopefully the material will be easy to digest. And I'll be speaking a lot just from my experience and my knowledge, so it won't be boring reading from the slides. They're just there to help guide the presentation. All right. Okay. So Angel Investing in Venture Capital 101, what you need to know and how to get started. So I did this webinar, something similar once back in April. So this one, I changed it up a bit just to get right down to specific information about venture capital and angel investing. However, if you ever wanted to know more about just investing in general, send me a DM. And you know what, if there's enough demand, then I can do a separate webinar that's just on financial basics. Okay, let's begin. Okay, so the agenda will be angel investing in venture capital, the basics, why we need you in this space, becoming an angel investor or venture capitalist, and the type of investors that are out there. I put them into 3 different buckets. Where to find the deals, so where to find the companies to invest in. And I also like to subtitle this, why this is the real problem, and we'll get into that later. And then how you can become a venture capitalist / angel investor today. And then we'll finish off with a Q&A. And if there's time, then I can share some more info with you about success stories that have to do with equity crowdfunding. And then Michelle, if you could type, Michelle Wise, if you could type in the chat, like, or if anybody can, did they have an issue coming into this presentation through their desktop? Or, and so I'm just wondering if it's a technical issue in general, or if maybe it's just with Michelle, your desktop. So let me know in the chat if all of you were okay getting to the presentation. Okay, great, thanks, Erica. Okay, excellent. Sorry, if you've been to my last couple of webinars, you know, like there's always some little blunder that happens or tech issue that happens. So I always like to just make sure that everything's smooth and that the event is accessible to everyone. All right. Okay, so let's get into the basics. Awesome. Let's get into the basics about angel investing and venture capital. All right, so the difference between the two. Angel investing, so an angel investor, also known as a private investor, seed investor, or angel funder, is typically a high net worth individual who provides financial backing for small startups or entrepreneurs, typically in exchange for ownership, equity in the company. And so angel investing usually comes after the friends and family round, and I'm going to speak to that in a little bit. So it comes after the friends and family round of investing, but before the venture capitalists come in and give their funding. And again, I'll elaborate on that in a couple of minutes. Let's see here. And so you can invest, you can angel invest as part of a group or a syndicate with a lead investor. And that's a great way to, number one, is piggyback off of somebody who's already experienced if you don't have the time to source deals yourself. And also, you know, more heads are better than one in terms of like your investing power, like how much money you have to back a startup. And angel investing and venture capital are very high risk, but also very high reward. And I'm going to say that a couple times throughout the presentation so that it's really drilled in. Okay, so when it comes to the investment stages, in the previous slide, I talked about how angel investing usually comes after the friends and family round. So basically the investment stages are as follows. You can see here. So first you have the idea, right? So that's like a founder will have an idea for a startup, and then they start the company, right? They get going. And typically, like how they keep the company going is by something called bootstrapping. And you've heard that expression before, which which can be problematic, but in this context, it's not. And bootstrapping means that, you use your own funds, you're self-funded in terms of just getting your initial product or company concept off of the ground. Sometimes, people use their savings, they use the salary they make from their jobs, they use OSAP, or they will even put it on credit cards. So you're finding the capital yourself in order to start the company. Then after that is a friends and family round. And that's kind of the unofficial round where, parents or friends who have a little bit of money, they either loan it to you or they give it to you in exchange for a piece of the company, right? And I just want to point out that this can be problematic in the venture space from the perspective of a founder, just because, if you're a founder of color, or sometimes even a woman, you just don't have the network that has access to even just an extra $25,000 to help you build your minimum viable product, which is your MVP, which is the first iteration of your technology, right? And so a lot of founders get stopped because they don't have the network to be able to fund them to the next stage to get their product ready and to prove their concepts, so that by the time it needs to grow or needs to scale, angels are ready to come in and inject more capital into their business. So I just wanted to say a note about that, just to throw it out there. And then after the friends and family round is the angel round. And, sometimes some founders, again, they go right from bootstrapping to the angel investment round because they don't have that friends and family round. And there's a myriad issues around this, including the fact that the angel investments can be smaller, or the angels can, demand more, a bigger percentage of the company in proportion to what they've invested, right? Just because there wasn't that buffer of trusted friends and family there to provide that capital stress-free. Now, I'm not saying angels are out to take as much equity of your company as possible. It's just something to consider. And then there's, so then you get the angel investment, and the angel investment happens usually when I guess you could say the company or the product has proven, that there's some momentum there, that there's, some demand has been generated, and it looks like there is actually potential for this company and this technology to grow into something big. Is at that point that in order to scale the company faster, an angel comes in and hits it with an injection of capital, money. And then from there, the founder can grow the company and again, go to the next step of proof of concept. And if it does look like, this company, this technology has legs, that's when the venture capitalist comes in and does Series A, B, and C rounds of funding. So Series A is the first round, and it's typically an investment of say $250,000 around there, maybe even $500,000 or $2 million. The Series A's are getting bigger and bigger these days. And then after that, there's a Series B round and there's a Series C round. And basically each step in the investment stage, if you can get to the next stage, that's further proof that, your company has a lot of potential. And it's almost like proving it's going to be successful with each stage that you fundraise for. And then by the time you get to Series C, there's a really good chance that this is the later stage, or what they call late stage, whereas say angel at seed stage and Series A is more early stage investing. By the time you get to Series C, which is later stage, there's a very good chance that the company is going to have a liquidity event, which is, an indication of success, right? And so a liquidity event is, for example, a company going public on the stock exchange, the way Uber did a couple of years ago. So at that point, by the time that the company hits the, hits the New York Stock Exchange or hits like a venture market, then at that point, then it's likely that all the investors that came before, from friends and family all the way to Series C, has made a decent amount of money. And the earlier you get in, the more money you're going to make, because the more risk you took. So liquidity events, again, they can be, say, a company going public on the stock exchange, and that's called like, an initial public offering or an IPO. Or it can be, getting acquired by a bigger company, right? At which point that's like another exit, if you will, another word for a liquidity event. Another liquidity event could just be the fact that that the company maintains private ownership with the founder and the investors that invested in all of these rounds, and just becomes a very successful, profitable company, and is able to even, pay dividends to its investors. All right, so now that I just did the little spiel about the investment stages, in the chats, can we guess, based on this picture of Jeff Bezos, where in the investment stage he is? It's like a little pop quiz. So that bootstrap, friends and family. Hi, Eliana, nice to see you. And come on, more guesses. Bootstrap. Yeah. You guys are all pretty close. Like here, he's on the verge of angel investment, but when he started Amazon, his parents, I believe, invested $250,000 into the business. So that was the friends and family round. And as you can see, and so like when you read articles, it says that his parents invested their life savings. That's a big question mark, because from what I hear, he comes from an affluent family. And I'll, again, just to highlight the fact that with the friends and family round, like if you have that network of wealthy people, like, you're like a rich uncle somewhere, some friends, your parents, that makes it much easier to start up a company and just focus on developing a really good strategy and a really good product, right? And a lot of, like, BIPOC and founders of color, they don't have that opportunity. So sometimes when we look at these founders like Jeff Bezos and Bill Gates, yes, they are brilliant. Yes, they are geniuses, but they still got a head start, quite frankly. And I'm just throwing that out there. But we all use Amazon today, so, kudos to Jeff Bezos. Okay, now here we are again with Amazon. Guess the investment stage. Type it in the chat. This might be a little trickier. IPO. Anybody else have any guesses? Any more guesses? So we have here liquidity, IPO, Series B, Series A. Any more guesses? So this is actually either liquidity event or IPO are correct answers. So at this point now, they have IPO'd and they hit the market. So the NASDAQ is a public market. Like by the time Amazon has got on the NASDAQ, that means it's out there in the public, like people can buy shares. They just buy it on the NASDAQ. They don't buy it on the New York Stock Exchange. So whoever said IPO or liquidity, you are correct. And on top of that too, a lot of these investors who kept their money into Amazon did a very good thing, because if you remember in like the early 2000s, 2003, 2004, Amazon was like tanking. Their shares were crashing rapidly, but they held on because Jeff Bezos was so firm in his vision that he just continued on, despite his share price tanking, and he still was like a huge shareholder. And now look at it today. Amazon is basically the internet of everything. Okay, great. So now that we know a little bit about angel investing and the stages, where angel investing is in the stages of the investment, let's take a look at venture capital. So venture capital is a form of private equity and a type of financing that investors provide to startup companies and small businesses that are believed to have long-term growth potential. So remember what I said before, by the time a venture capitalist comes on, or venture capital company or fund comes onto the scene and injects capital into a startup, they are saying, or it's commonly known, that there's a fairly good chance that this company will be successful in the long run. So it's not guaranteed and it's still extremely high risk. But once you start getting into the venture rounds of funding, it's starting to like look a little rosy, even though a ton of startups that make it to the venture round fail. Like me personally, from what I've seen, about, I would say, like, say you have 10 startups that like a venture that a venture capitalist has invested in, typically it's going to be like 4 or 5 that kind of break even and disappear or chug along. Then it's going to be another, say, 4 so that completely disappear, right? They tank and they crash burn and disappear. And then it's going to be like 1, maybe 2, but typically 1 that's like the breakout success that makes up for all the other failures. So that's typically like the math behind a venture capital. And sometimes it doesn't work out that way, but if a venture capital firm knows what they're doing, if the general partners know what they're doing and they're good, and a little bit of luck or an investment strategy or a really good investment thesis, then typically that's what happens. And I just wanted to talk here a little bit about private equity. So remember I was talking about the public markets. So a public market means, and a public company means that anybody, you, me, anybody can buy a share of that company. So buy a piece of ownership on that company, like whether on the New York Stock Exchange, on the Toronto Stock Exchange, on the NASDAQ, for example, which is like the venture fund in the States or the venture market in the States, right? And the reason why anybody in the public can buy that share is because there's a lot of regulation around reporting, financial reporting for those public companies. And that financial reporting is public. You can either find it on sedar.com, SEDAR.com, or you can go to that company, like say Coca-Cola, you go to their website and like somewhere on there, you can find like their financials. And so theoretically then anybody off the street has access to the right information and to completely accurate and consistent information that will help them determine and analyze whether buying the shares are a good idea or not. On the other hand, with private equity, that means it's private investors, like private owners, which means it's much harder to determine and analyze whether a company, whether it's a good idea to place an investment in this company or not, right? And that's typically why it's been much harder for, say, the average person to invest in a venture capital fund, unless, your BFF or your cousin founded a startup and you want to throw some capital their way. And because a lot of due diligence, and I'll talk about that in a little bit, has to go into analyzing these startups to see if they meet your investment thesis requirements. We'll talk about that later. And if they have really good long-term potential. And it takes a lot of practice and a lot of skill to be able to do that. And on top of that too, it takes a lot of money. And so that's what makes it much harder to get into. But we're going to keep talking about that as we go along in this presentation, because I really want to demystify and open access to this kind of information. Okay, so venture capital fund structure. It's pretty simple. So you have a venture capital fund, right? And the fund is basically, it's a bunch of investors that pool their money together, right, to create the venture capital fund. And so those investors are called limited partners. And the reason why they're called limited partners is because they have limited liability, meaning that they will only lose what they invested, versus the general partners who are, typically they're basically the C-suite leaders of this venture capital firm, like the company. And not only have they a lot of times they've also, injected their own investment capital into the fund. But not only that, general partners are the ones that basically run the venture capital fund. They run the firm, like the company, and they're also the ones going out there and finding the deals and deciding to make investments in that deal. So you can see, like, so from the venture fund, in the middle is the general partners that then, using the money in the fund, invest in, startup 1, 2, 3, on and on and on. And again, these investments can be anywhere from, say, $250,000 or more, right, is what they're investing into the fund. And the limited partners are investing, at minimum, $150,000, which is why most of the time, if not all the time, investing in a VC fund is only limited to accredited investors. The good news about that, though, and you can DM me afterwards if you like, or send me an email, is that there are some funds now that are focused on diversity, not just diversity of founders, but also diversity of funders. And they're allowing investors to come in investing at a much lower amount, like say 25,000, 50,000 and upwards. And I see a message here from Paige. Do the general partners take a percentage for their salaries? Ooh, good question. Thank you. Or does it depend on the setup of the VC? Yeah, it depends on the setup of the VC, but the most common structure is that there's a management fee that the general partners take to not only fund their salaries and to go towards the operating the fund and operating the company, right? And so the fee structure, if you want to use venture capital lingo, like if you want to sound like a hardcore venture capitalist or professional, then you'll say something like, oh, the management structure is 2 and 20, right? Or 2 and 30. And so when a GP of a venture capital fund says, oh, like the management fee structure is 2 and 20, what that means is out of the entire fund, the GPs will use 2% as a management fee, right? So for example, like I'm not even gonna do the math, but like, so if a fund has $20 million in it, then 2% of that will go towards like salaries and operating the fund, like, like renting out the office, paying the scouts to go find deals, et cetera, et cetera. And then the 20 part of that little phrase means that any profits that are made from this fund, the venture capital company, the firm, and therefore the general partners make 20%, right? And that's, I know it sounds like a lot, but that's very typical in the VC world and also in the hedge fund world too, right? Like once you make a certain amount of profit, like right away, the general partners get 20% of it. And people don't complain because, everybody wants profit. So as long as they get to profitability in the fund, then people generally tend to not complain if the general partners, who have done most of the legwork, takes a bigger proportion for themselves. I know of some VC funds, though, that don't have any management fees. They just set aside a bit of money from the fund in order to pay like lawyers and things like that. And they draw their salaries from like a separate, I guess, company. Like that's, that's like an accelerator, for example. And that makes it really appealing to investors. But for the most part, it's the 2 and 20 fee structure. Okay, so we talked about this before. The venture capital investment comes after any angel investment rounds and typically comes from well-off investors, investment banks, financial institutions, family offices. And family offices are basically where an individual or family is so rich, like we're talking like $20 to $50 million, that they literally have their own wealth management firm set up with like real estate agents, lawyers, brokers to manage their money. Like it's like a full-time job for a bunch of people. And so same with angel investing too. Like you can also, like the venture capital investment can also be in the form of technical knowledge or managerial expertise. Like if you have deep knowledge on a subject and experience on a subject, then, a part, if not all, of your investment can actually be your knowledge, your brain, right? That's more rare, but it does happen. It is possible. And again, high risk, high reward. And I would say very high risk, very high reward. Okay, now that we have those that bit of technical information out of the way, let's get into the nitty gritty here. Why we need you. Like why we need you, all of you on the call, like Maya and Emma, Amy, Paige, Kanisha, why we need your voices, like Erica, all of you. Or the subtitle could be, how the lack of diversity in tech is destroying the planet and the world and society as a whole. So just some stats here. So, and these are stats by a VC firm called Highline Beta that I'm affiliated with. And so the first one is here, 15.2% of VC firms in Canada have a female partner, which means 74.8%, 84.8% don't. This is way too out of balance, and you know, the numbers are slightly higher in the States, and this is this is a 2019 number, and this is an improvement over 2018, which is good, but still this is pretty dismal, right? We need representation. Exactly, Shani. Wow, indeed. Like we need representation, and I'll get into the impacts of this in a minute. And in 2018, 85% of capital invested by a limited partner was into a VC fund with 0 women partners. And we're talking whether they're limited partners or general partners, which is ridiculous. And if you note here at the bottom of this slide, it says that 4.6 billion is invested in active Canadian funds with no women partners. That's $4.6 billion that women, like let alone people of color, aren't even touching. And if you're Black, like there's not even enough data to even measure these numbers, but it's improving, which is great. Again, like we'll discuss that in a moment. And angel groups, like we talked about before, which are a bunch of investors that come together and can collectively pool their money and collectively invest. About 16.7% of angel group members across Canada are women, and this is a slight improvement, but it needs to get better. Okay, so what does all that mean, right? I didn't even put down the stats about people of color, etc., because it's so below the radar, it's like basically immeasurable. And so the lack of diversity and inclusivity in the investing, not just being a founder, but in actually being an investor, limited partner, or general partner, that equals what I like to call opportunity hoarding. And some of you who know me know I use this term a lot. It also means lack of representation, income equality, massive wealth gaps, power imbalances, abuses of power, prioritizing the good of the few and not the many, and also technological biases. And we're going to get into that because right now these look like a bunch of negative words and phrases on a page. So let's actually do some real life application of the implications of this lack of diversity. Okay, so opportunity hoarding and lack of representation. Have any of you like heard of anything called pattern matching? It's like, I'm like looking in the chat. Let me know if anybody's heard of something called pattern matching. Pattern matching is, I would say, pre-2017. It's what a lot of like investors, high stakes, we're talking multimillionaire investors, use to find startups and founders to invest in. And it's honestly, it's a euphemism, or it's a nice way of saying like straight up bias and straight up racism, because basically, you know, pre-2018, 2017, investors were looking for founders who went to Standards, who were antisocial white males, who wore hoodies, right? Because that's what many of the successful founders with unicorn, you know, billion-dollar companies, that was the profile of their founders. Like, you know, Mark Zuckerberg and Facebook is a good example. So literally investors who are also white males that a lot of times went to Harvard and Stanford would like seek out just that profile. It didn't matter if the founder had like a grilled cheese delivery startup, which did exist, by the way, and did get like a million or two in funding. But no, because the founder matched a certain pattern, hoodie, white male, Stanford, Harvard, antisocial, like he got funding, which means people out there who have a great idea, who have a product out there that can benefit society and be extremely profitable, were overlooked to the point where it's actually offensive. You know, and this pattern matching and stereotype reinforces itself over and over again. Like that's why, you know, when you like, does anybody know the show Silicon Valley? It's a show that's on HBO, and these are the characters on the show, and it's supposed to be a good parody of what it's like to work in Silicon Valley, and this is basically what they think that Silicon Valley looks like, and for the most part, they are right. And it's really annoying. And then let's not even get into, okay, let's get into inequality and the unequal distribution of wealth. I mean, like, look at the top 5 richest people in the world right here. Like, anybody have any guesses to who they are? Can we point them all out? 3 out of 5 of them do have tech startups, or that were startups. Maybe you can type in the chat who, if you recognize any of these guys here. Bill Gates is number 1. Yep. Yep. Jeff Bezos number 2. Warren Buffett number 4. Zuck is number 5. And in the middle is, I believe his name is, his last name is Arnault. And I think he's the chairman of of LVMH. And they're the big luxury conglomerate that owns like Louis Vuitton and a bunch of other brands. And I think he's married to Selma Hayek, if I'm not mistaken. But I mean, but take a look. Like, these are the top 5 richest people like in the world that we, you know, that we know of. You know, I'm sure there's some oil people out there who maybe secretly have much more money, but in terms of like public record, these are the wealthiest. And so when you have, I'm gonna go back. So when you have, when you have the majority of people in Silicon Valley in tech on the founder side and on the investor side that look like this, and that look like this is what happens. Like the woman on the left here, her name is Ellen Pao, and she was a principal, so a high up person at one of the biggest venture capital firms in the world, Kleiner Perkins, and she sued them for sexual harassment because she was being sexually harassed, and she lost. And then on top of that too, then she went over to Reddit to become the CEO of Reddit, which is like, and they basically put her on the path to being to going off a glass cliff. And a glass cliff, like we've all heard of glass ceilings for women. A glass cliff is when a company is in peril, pretty much. And so they bring in like a woman CEO, they bring in like a woman of color CEO to almost like take the fall for the company, or to blame the company because the ship was too hard to turn around. And Reddit is still around, but she was blamed. Like, she did come in at a very difficult time at Reddit, which was super frustrating to watch. And then we have Travis Kalanick, and I can't even get into, like, just Google him and what he was about. He was the founder of Uber, which is great, but the culture at Uber, the reports were insane of the sexism and the racism, and I mean of, you know, of all the guys in the company, you know, going to strip clubs for fun and things like that, and making women feel uncomfortable. Like, it was a really toxic workplace, and you know, so once it became public, thanks to a female whistleblower, Kalanick had to step down. And then even at Bumble, which was founded because there was so much sexism at Tinder, so Whitney Wolf founded Bumble. Again, you still find all sorts of like crazy abuses of power and power imbalances between men and women, and men and other people of color. And then, you know, and here's an example of what happens also. It's not just power imbalances, it's also the fact that the like inherent technological biases are built into the actual product, into the actual technology, when it's typically only like one profile of person that is designing and building these products. So if all the investors are, say, for example, of one profile or one pattern, like, you know, like a white male, and all the software engineers and software designers are of one pattern or one profile, i.e. white male, then what happens are that these, especially, by the way, if these profiles like live in an insular bubble where they don't interact with other people of color or other women as much, they don't have exposure to much culture, what happens is their bias, whether they realize it or not, are actually built in to the software, and it's getting more and more important to understand this as AI starts to run the world, like artificial intelligence. Like, can you imagine the implications if AI and robots are seen through the eyes of a wealthy, privileged white male? What does that mean for the rest of us? It means things like, you know, women automatically being denied for credit card applications who have equal qualifications, right? Like, it can be something like that. You know, it could be when testing driverless cars, these driverless cars actually hitting people with darker skin and black people and black dummies because they are having trouble, like the technology is having trouble identifying dark skin. Like, that's wild. And that's not, to me, that's not even the most dangerous thing that can happen. And here's another one: overcoming racial bias in AI systems. Yeah, and in self-driving cars. Like, it's frightening. Yeah, and I love what Zoe said here, especially with artificial intelligence not registering people of color faces or deeming certain facial features aggressive and more likely to commit crime. Absolutely. Like, I mean, this is far and wide, like this horrible, horrible phenomenon. So that's why we need you. That's why we need you to become investors. That's why we need you to become supporters of the industry. We need you to become vocal in this industry, and we need you to become, you know, software engineers and software designers. But if you're like me and you just suck at programming, you're like, well, you know what? Let me become an investor, because as we'll see later on in this presentation, like, becoming an investor is or like, you know, an angel investor or venture capital investor, you have direct access to these startups, and if you want, you can actually participate in, I guess, in how the company develops and runs over time. Like, for example, like, I'm a limited partner in an investment in a venture capital firm, and starting in 2021, I'm going to be an advisor to a fintech, so a financial technology startup that's already raised millions and millions of dollars. And, you know, with my little voice at the table, with me speaking directly with the company CEO and their head designers, I get to have a say, right, in and how the technology functions and who it's built for. And so the more diverse voices that we have at the table, whether as a VC angel or on, you know, on the software side, the better it is for all of society. Like, I cannot emphasize that enough. Especially because, you know, with the pandemic happening, we've been thrust into a new technological era way faster than we would have been before. Like, before, we were chugging on at a pretty rapid rate of, you know, of becoming like a hardcore tech society. But this pandemic has just fast forwarded that. Okay, so on that note, who are angel or venture capital investors? So my mentor and I, who's like a general partner at a VC firm, like, we were talking on the phone the other day, and we put them into 3 buckets. So there are the first bucket are entrepreneurs and active angel investors. Now, so these are people who like they've made a career out of angel investing, right? And are living off the returns. They give their advice, and oftentimes those angel investors are entrepreneurs that have either sold their business or had a really good exit, liquidity event, and so now are independently wealthy and can now dedicate their time to quote unquote giving back in a way, and that is investing in other startups and advising them. But sometimes angel investors aren't entrepreneurs, but typically they have an entrepreneurial bent to them. They're also business leaders, right? So they can just be people who are high up in the corporate world, who are accredited investors, which I'll talk about in a minute, and who, they can lend their leadership expertise as well as their investment. And also they have connections within that whole Fortune 500 company as well. And then there's public market investors. So public market, it's just people who are, they may have a day job, they may not, but they're people who have invested in stocks, bonds, mutual funds, like a lot. And they're looking for other places to invest their money, especially if they have like quite a decent sized portfolio, like $1 million or more, who can afford some kind of who can afford to make a higher risk investment. And on that note, all of these three groups usually have one thing in common, and that's that they're accredited investors. And, once you get beyond, like, say, the friends and family round of investment, the investors tend to be accredited investor. And an accredited investor means either you have $1 million liquid net worth, or you have, say, or you make like $190,000 to $200,000 Canadian a year for a certain amount of years, like for 2 or 3 years in a row, or you and your partner, like your household income combined, is $300,000 a year. Now, of course, this leaves many people out of the equation, right? If that's what you have to make. And that actually, for the longest time, stopped me from becoming an investor as well. Because I was like, well, I'm not an accredited investor, so I can't do this. It's not fair. But as I started reading more and more, I'm like, oh, there's ways around it, right? And so we're going to talk about one way towards the end. But in the Q&A, if you have more questions about it, then let me know. We could talk about it. And yeah, that's another great question, Paige. She asks here in the chat, do you have to register with the OSC to be an accredited investor? So the Ontario Securities Commission, which is like a regulatory body that regulates, I guess, like securities in Ontario. So like stocks, bonds, and mutual funds. And no, you don't. Like, wink, wink, nudge, nudge. No, you don't. I'm just kidding. No, you don't have to register. There's no formal, as far as I know, and in my experience investing in a VC fund, there's no formal way or certificate that you apply for to call yourself an accredited investor. Like, what happens is like if you're investing, if you're angel investing into a company or into a venture fund, when you do your paperwork, they ask you, like, are you an accredited investor? And if so, by which means, like, you have $1 million in the bank, you and your partner make $300K a year, you make like $190K or $200K a year. So you check that off. And the main reason why you have to be an accredited investor, and I think I talk about it a little later on. Yeah, I do. I talk about it a lot, actually, is that, they don't want you investing more than you can afford to lose. And you can lose like basically your entire investment easily, right? So they want to make sure that you can afford to do so. And I like Maya and Emma's, I love their comment here in the chat. Middle class in Canada make less than 70K. Yeah. And in Toronto, I think to be middle class, it's like 130K now, something like that. Yeah, exactly. And, with everything that's happening right now, it's more important than ever to have new investment and income streams, which is why I'm also a big proponent of angel and venture capital investing, like, if done correctly, which is why I'm so passionate about doing these workshops, right? So everybody is armed with a basic foundation of information. And then from there, you can go out and build on your knowledge base and make the best choices possible. And like I said, at the end, as Joanna asked, you can get involved at lower levels. I'll talk about that and when it comes to sourcing deals and also equity crowdfunding, which we'll talk about at the end. Okay, so is angel and venture capital for you? So this is where you have to ask yourself, like, what is your risk profile? Can you stomach big losses? Like if you were to plunk down $25,000 into a startup company as an angel investor today, are you okay with never seeing that money again? If you plunk down $150,000 into a VC firm, are you okay with never seeing that money again? Because that's the worst case scenario. And you have to be comfortable with that. Like whenever I make an investment like that, I tell myself I might never see that money again, and I have to be okay with that. And that is why you also have to consider your age/life situation. Hello, Joanna. I know it's scary, but I know it's like, you know, venture and angel is not for the faint of heart unless you have so much money that you don't care if you like lose, you know, 5 or 6 figures here and there. But anyways, but given your risk profile, like that goes hand in hand with your life situation, your age. So for example, me, I'm investing, say, like 150,000 into a venture capital fund. You know, and like it's spread out over a couple of years, like the chunks of investments you make that total $150,000. I have to be okay with losing all of that money, right? I have to accept that and I have to, and you know, adjust my expectations accordingly. Like, of course, I'm hoping and I really want, and I'm confident that like I'll make a lot off that investment, but at the same time, I have to understand that I can lose it. And I'm still young, right? Like, you know, I'm still in my 30s. I have many more years of life and of working and of career ahead of me, knock on wood. I have a solid underlying foundation of investments already. So I can afford to, you know, at the end of the day, I can afford to lose 150K. It'll really suck. Like I'll cry, but I have time to make up for that. Like if I'm, you know, if I'm retired, if I'm 70 years old and retired and you know, and I'm living off of that retirement and every penny of my budget counts, then, you know, angel investing in venture might not be best for me unless I want to write like my granddaughter a check because she's for $25,000 because she's starting up. But aside from that, you know, I might not want to become a professional venture capitalist or angel investor. So you really got to look at where you are in your life situation because you need to have enough time to be able to recoup any losses, right? Through your earning potential. And on top of the two is life situation too. I mean, the tip, you know, if you are recently married, you know, you have one kid, another one on the way, like you just have a mortgage on a house in Toronto, you know, it might not be the best time to make those kind of investments because not only are you investing money that you can lose all of, but you can't touch that investment for at least like say 5 to 10 years. It's completely locked in. And also, you know, your income and your net worth, like they have to be like high enough that you can save and put together the capital to actually invest. Then you also have to think about your interests and passions. Like, is this something that really interests you? And I assume that it is because I've had so much interest in this workshop, right? And most importantly, there's 4 requirements you need, right, to actually make the investment, to actually become an angel investor. They are capital, deal flow, due diligence, and your thesis. So if you can gather all these 3 together, then you can become quite a successful angel investor or venture capitalist. But it's really, really important to have all 4. You can't just have 3 and then miss the other. Sorry about that. So capital, we'll talk about the first one, which is capital. So capital is just the amount of money you've allocated towards making your investment. So, you know, the minimum for an angel investment where you just invest in one company is typically $5,000. It used to be $5,000, but over the past 10 years, the minimum is more like 15 or 20 to 25,000 right now. But oh man, I'll share this on my Instagram stories, but like back when Uber was just starting up, when it was Travis Kalanick in his 1-bedroom apartment with his co-founder, there were a bunch of people that made 5,000 investments, but are now worth like $100 million today. An angel investor named Jason Kalanakis, he's one of them. And so you can look up that, and like that $5,000 investment turned into $100 million as soon as Uber, over like 10 years later when Uber went public on the stock market, which is wild. We're going to talk about why that's a little bit problematic in a moment. But to become a limited partner in a venture capital fund, the minimum investment is typically $150K to $250K. Like I said, now there's funds out there where like you can get in at 25,000, 50,000, 100,000, but for now, it's mostly 150 to 250K minimum. So the next thing is deal flow. So deal flow is the pace at which you receive or create opportunities to review potential new investments. So another way of saying deal flow is how many interesting startups come across your desk that you might be interested in investing in. Deal flow is everything, and I'll explain why. Sorry about that. Okay, so how to generate deal flow. So to generate deal flow, right? So to get more opportunities to meet more founders, to learn about more early stage startups, you can go to demo days, you can go to pitch days. So demo days and pitch days are like activities in the startup scene. Like in Toronto, we have them all the time before COVID, right? Where founders can showcase their technology or their company and to a room of investors, and then investors can then approach them afterwards. And hackathons is another way too, and that's where some kind of startup organization, they're like, let's solve a technological problem by getting a bunch of software developers into a room for a weekend, and they all work together to code some kind of technology, right? And then also like university final projects. Like I know somebody who was at U of T for computer science, and their final project actually turned into their full-time job because they presented it. A couple of angel investors were there. One of them was super interested in the technology that they presented. And also university competitions as well. University of Waterloo is the place to find these kind of potential early stage companies and deals. And also there's tech conferences like Collision, for example, that happened, I think, last year, the year before. There's investor events, and there are also like warm leads and introductions from people who know that you're looking to invest, and your network. So finding deals through your network, just like Jason Kanalakis, right, who was like a tech writer in Silicon Valley who knew Travis Kalanick and was able to invest $5,000 into Uber right when it started. So like we can all go out there and find like our own version of Uber to invest in 5,000, and the next thing you know, we become multi-millionaires, right? Right? Wrong. It sounds easy to choose that magical startup that's going to become the next like unicorn, the next billion-dollar company, but it doesn't work that way, because it's literally like finding that grain of sand, like on the beach, basically. Like you actually probably have a better chance of finding a specific grain of sand that you want on the beach rather than the next unicorn. Which brings me to the point, and that is deal flow is actually the hard part. Because, you and I, we can work hard, we can boost our incomes, we can flip out a couple houses, become millionaires, become lawyers, start our own businesses, make good money. And still, like, where do we go to find deals? And that brings me full circle back to opportunity hoarding, right? Where it's this enclosed few, Like they know all the deals, they know all the hot next companies, they know which deals have potential to go on to more and more funding. Just like that tech writer, Jason Kalinakis, who because of being a journalist in the tech in Silicon Valley, he knew all these people. So he was able to make a ton of investments. And when you're right where the action is, when you're in those inner circles, then you have a much better chance of investing in the next unicorn. So I really found that, like, as I was doing my research in 2017, 2018 on becoming an angel investor, becoming a venture capitalist, as I started doing my research and going out there and attempting to network, I realized that this was actually the hard part. Sorry about that. I'm just gonna go back. Sorry. Oh, sorry about that. I keep using the wrong buttons. My apologies. And then so we'll get into investment thesis, which is another thing that you need in order to become a successful investor. And so an investment thesis is an individual's personal strategy that will take abstract ideas and it creates a clear filter for making an investment decision. So basically it's what kind of investment you're going to make and why, right? So it helps guide your decision-making process. It supports achieving your investment objectives. It aligns with your core values. It builds your personal brand as an investor. So for example, if I wanted to invest in, in fashion technology that is going to disrupt the manufacturing industry, and I make a name for myself and I keep investing in those kind of startups, then those deals will start to come to me and I'll be known as that kind of investor. So that's an example of building your personal brand through your investment thesis. Bye, Amoy. Aw, thank you so much for joining. And also investment thesis, it improves relevancy and the quality of deal flow. Right. And, it's a great elevator pitch. So if you're meeting a founder, if you're meeting other investors and they're like, oh, what kind of things do you invest in? You know exactly what you're looking for right away. And honestly, my elevator pitch as it stands now is nothing special. It's nothing crazy. Honestly, it's basically, it's piggybacking off of what other already successful investors and venture capital firms have done. That's literally my thesis. My thesis is whatever other successful angel investors and venture capital firms have done, I am going to co-invest with them. Because one thing I realized when I was going through an accelerator for women who want to become investors is that I don't have the time to create the kind of deal flow right away that would get me those juicy deals that could actually turn out to be unicorns. I just didn't have the time and the resource to dedicate that. Going out all the time, I couldn't. So I was like, you know what? I'm just going to meet and network other successful investors and just do what they do. Okay, so there is currently a Black celebration. So this is a question from Joanna Ha. She said there's currently a Black celebration company that does gift wrap I am looking at. They have a great product, strong marketing plan, 25% profit margins. What other questions to ask? Oh boy. That's one that we would have to take offline because there's so many variables around it. And I would have to know what the product is. So maybe you and I can talk and then I can do an Instagram story or a series of stories about the kind of questions to ask investors. But a big one is the market, right? Actually, the two biggest ones I would say are, what does the market look like for this product? Is it big, or is it big enough that it can scale to their goals, to their projections? And then another thing to look at too is the founders. Are the founders passionate and obsessed with this company? Do they have a solid track record of building companies? Do they have experience? Even if a company failed, they still know what the process is building and executing a concept or a product or service, right? From concept to execution. So even if it failed or not, if a founder has a previous experience, that's a great thing. Do the two founders know each other? I would start there and go from there. But again, I can cover this offline Instagram story. It's a really good question. Thank you so much, Joanna. Okay, and so the last of the four are due diligence. We talked about due diligence before, and actually, Joanna, this goes perfectly into your question. What you're talking about is due diligence, and that is when an opportunity, like for investment, like a startup comes across your desk, you need to know how to analyze it, right? So you need to learn how to analyze it for potential market share, scalability, the founders are, the product market fit, right? Marketing plan. Has a minimum viable product been built? Has it been tested in market? Is it showing a lot of potential during those tests in market? Like their due diligence is a really, really thorough process. And again, because it's a private company, we don't have access to I guess financials that have gone through rigorous compliance like public companies do, right? So we have to take the word oftentimes of the founders themselves. And so so due diligence, there's almost like an art to doing it. And it's so important. And there's lots of resources out there and books on how to do due diligence. And actually there's even courses on it too. And I mean, maybe one day if this webinar evolves and as the community evolves, then there could be a whole separate webinar about due diligence. Okay, so we talked about opportunity hoarding. Okay, so how to get started today. And somebody asked a little bit further up, it's like, how can you get into this at a low entry point? And the solution is equity crowdfunding. And Equivesto, like, we have some people from Equivesto on the call right now, and they're a startup, a Canadian startup that is an equity crowdfunding platform that allows Canadians to invest in other Canadian startups, right, for as little as $100, like for as little as $100, which is awesome. And you don't have to be an accredited investor. And that's what separates Equivesto from other crowdfunding platforms. Like I know there's one in the States, there's a couple in the States, but an example of an equity crowdfunding platform, I believe, is something called Backstage Crowd. And if you know Arlen Hamilton, she's like that Black female venture capitalist out in the States, right, who totally broke down the doors for all of us to come in, all those women of color, Black women VCs to come in. She started the venture capital firm Backstage Capital. Oh, good, Ileana. Yes, I'm going to start reading that book too. Oh my gosh, you know what? I'm going to order it as soon as we get off this call. Thanks for reminding me. But she started the venture capital firm, Backstage Capital. Awesome. Then she started Backstage Studio, which is an accelerator that helps startups scale, right, so that they might be ready for investment. And then she started Backstage Crowd, which is an equity crowdfunding platform. But the challenge is that you still have to be an accredited investor to even qualify for her crowdfunding platform. And while there's no official certification to be, or certificate, or you don't have to register to become an accredited investor, when you register for, or when you try to apply to these different equity crowdfunding platforms where you do have to be an accredited investor, they actually make you prove it. Like they'll actually ask you for documents. And so, yeah, and then that will stop people right there. I know it stopped me, but with Equivesto, you don't need to be an accredited investor, which is really cool. Okay, so how to invest in startups with Equivesto. So also, if you don't, just to clarify, an equity crowdfunding platform is like a new type of fundraising that allows private companies to raise money by issuing small portions of ownership shares to a large group of investors. So this allows many more people to participate in the higher risk but higher return private investment market. So now smaller investors can participate in venture deals, which had traditionally required high minimum investments and limited to those who are considered wealthy, like I was talking about this whole time. So it's really cool that there's something like Equivesto now that exists. And so you go on their website, you sign up. I'll talk a little bit about that later. You look at the investment opportunities. So they'll profile companies that they have on their website, and then you make the investment. Right. And I took a screen grab here of what they have on their website. We democratize the private investment landscape. So the new equity crowdfunding rules in Canada allow all qualifying residents access to a previously closed off part of the private investment market. Equivesto is an opportunity for individuals to work with their community, support local businesses, and mutually grow. We believe in the potential people have when given the means, support, and opportunity. And together, we can create an environment where the innovators are not limited by the resources, but only by their courage and imagination. Exactly. And that's what it should be. And actually, I'm going to take a big break because I not a quick break, but I'm going to switch to a Forbes article to talk about some examples of equity crowdfunding that went on to fund successful companies. So one moment. And now you get to see my face again. Here I am still. All right, so let's see if I'm going to share my screen, but I'm going to share it for that Forbes article. Here we go. Okay, so check this out. 5 crowdfunded side projects that became multi-million-dollar companies. So this is just to give you an idea of actually how viable as an alternative equity crowdfunding is. And let's see, act like a lady, think like a boss. I love your username. It says, do you have to be from Canada to join that site? We're based in the US. And then Anya saying the same thing. Yes, you have to be Canadian, but hold on, don't go yet, because I'm not going to mention any Canadian companies. However, I'm going to go through like the process of registering for the site, like kind of information they need, because it's typically the same thing for the States. And afterwards, please send me an email or DM me, and I will see if I can find an equivalent for you, because for now, as far as I know, Equivesto is Canadian only, okay? And Zulani, you can jump in if you want to add any comments to that. But yes, email me afterwards and I'll do some research for you, no problem. And so here are 5 companies, right, that started out from equity crowdfunding. So I've heard of these companies because I'm super into tech, but Oculus virtual reality headset. So Oculus started out as a crowdfunded company. It actually did. And look, they bought it with, they was purchased by Facebook for $2 billion in 2014, which is amazing. And then there's Pebbles. Have you heard of Pebble? Like, I think they started as a watch, but now it's wearable devices. They raised 10 million. It went, like, I remember this, smashing its goal, and I do remember it went on to be super successful. Oh yes, and that's right, it went through University of Waterloo, students there. And then there's Skybell Video Doorbell. And then there's the Tile app locator for missing stuff. I've heard of the Tile app. And there's Braggy wireless headphones. So those are 5, and I will also let you know about 5 more. One second here.
Hey Mel, I'm just gonna jump in quickly to address Anya's question.
Yes, please do.
Canadian? So if you're not Canadian, you can still participate in equity crowdfunding. That's the good news, just not through Equivesto, because Equivesto is only registered as of right now in 4 provinces of Canada: Ontario, Alberta, Nova Scotia, and British Columbia. We're going to try and expand to all of Canada. That's the goal. But unfortunately, the regulations in Canada and United States are drastically different as of right now. So we just can't take investors we can't legally take any investors outside of Canada, unfortunately.
Thank you, Zulani. Thanks for jumping in there. I'll share. And so I'm going to like wrap up a little bit more about registering on Equivesto's site, and then we'll get to some questions. I can stay on like for as long as people have questions, and at the 8:30 mark, because I want to be mindful of everybody's time. If you want to hop off, please do go ahead. Actually, let me stop share and share another screen. One moment. Let's go back to my presentation. There we go. Okay, so while it is easy to sign up, because I personally did it and it was quite easy. And one thing that didn't phase me, but it might phase some people who are unsure of how it works when it comes to Canadian regulation, is that they do ask and collect a lot of information. And really it's for your protection, because basically the Canadian regulatory bodies, they want to make sure that you are protected as an investor. And so we have to ask you this information. And I'll get into more detail about why certain information is asked in a moment. And so the kind of information they ask from you is your name, your current address, and your citizenship. And this is to confirm your identity, right? And to confirm also, most importantly for this group of information, that you are a resident of, say, Canada, and you're a resident of the province where these regulations apply. And that will make you qualified to invest. And they also ask you things like your date of birth, contact information, and your social insurance number, which is optional. The reason why they ask this chunk of information is just because they want to confirm your identity, right? And you don't have to give your social insurance number, but it makes it easier to confirm your identity that way. And as a financial advisor, by the way, on the paperwork that I fill out for some of you who are my clients, they do ask this stuff if you remember. So it's not just with equity crowdfunding, it's any kind of investment. So even at the bank with your financial wealth advisor. And then this next batch of information, they ask like your employment, your marital status, your annual income, and net worth. So they ask these questions because, as it says here, they're an important piece of the puzzle when taking a holistic look at your financial situation, and they help determine like how you make a living. And they do this because angel investing is so high risk. They need to know that you're literally not like betting next month's rent. You know what I mean? That you're not gonna that you'll be okay if the investment didn't pan out. So again, for your protection. I feel like I'm missing. Oh yeah, there you go. Then they also ask things like, are you a politically exposed person? And this is to make sure that you're not using the proceeds of corruption, of government corruption. I don't think anybody here is like Pablo Escobar, like buying off the government, right? No? Okay. Just checking. And investment objectives and risk profile. And this, again, like I said a million times, this ensures that you understand that equity crowdfunding is high risk and that you can handle that risk and that it fits your investment goals. They literally want you to confirm this to make sure that they know, so that you know what you're getting into. And then also they want to know if you participated in other recent crowdfunding campaigns. And I'll get to your question in a moment, Maya and Emma. That's a good one. So the regulation limit is, if you're an accredited investor, you can invest up to $50,000 a year in crowdfunding campaigns. And for everyone else, the rest of us, is $10,000 a year. And Maya asked in the chat, do they do a risk assessment do they match you with certain companies based on your risk assessment? And the answer is no. Like ultimately it's your decision, but they need to know that you can handle high risk and that you are aware that the investment is high risk. And once they know that, it's in writing, it's documented by you and signed by you, e-signed by you, then you can pick the companies that you want to invest in. Oops. Okay, and then about know your client, KYC. So know your client KYC is basically what would I call it? It's a collection of specific data about an investor like their investment knowledge, their risk profile, the time horizon. So whether they're looking to use this investment in 0 to 3 years, all the way up till after 10 years, that the client understands the risks involved and that they are able to eat any kind of losses. And so you just ask like a series of questions, like just these questions here. And that is to make sure, again, it's another step of protection for the client so that the Equivesto and government regulation know, and the client knows that everybody is aware of the risks involved. And with that, you could reach me again at allen.melissa@gmail.com, at Mel Talks Money on Instagram. I'm not as active on Twitter, but I'm pretty active, and I'm Money Talks Mel on Twitter. And so it's 8:25. I'm going to stop the share. We can take some questions. You can either hop on to the screen or you can ask it in the chat. Let me know, because that's the end of my presentation. Okay, so I see one here has popped up from Ileana. On a high level, how does Equivesto select their startups? Well, that's a good question. I mean, I could speak on behalf of Equivesto, but Zulani, if you're on, maybe you can have more insight into that.
Yes, there are currently 3 campaigns live. Yeah.
And there, you will be adding more and more, right? Because you literally just launched Equivesto to the public, what, like a week ago?
Actually, we did. We launched a month ago, and at that time we had 2 campaigns going on, and now we have a third one. Actually, we launched it today, and then we're going to have a 4th one next week, and then like that. We're aiming to launch one campaign every 2 weeks for now. Mm-hmm. But yeah, soon it's going to be a lot of campaigns to choose from, a lot of companies.
Perfect. Thank you, Zulani. And I think you and I decided that we're going to, as a treat, like you'll get to meet some of the founders on some IG Lives in the future.
Yes, absolutely. And you can ask them any questions. I'm sure you'll have many. But yeah, super excited for that.
Awesome. I'm looking forward to it too. And I love it. Amy, awesome. So you're already registered on Equivesto, super easy process. Thank you for that feedback.
Yeah. Oh, wow. That's great, Amy. Thank you for that. I love it when people say that it's a super easy process, because I know it's like a lot of pages, a lot of questions, but believe me that at the end of the day is to protect our investors.
It is. And some of you, I think there's a couple of you who are my clients. And so you've seen, like, just to open an account, and I'm on a different, like, I guess, market, right? I'm on like the Mutual Fund Dealers Association platform, but still, like, the paperwork just to open an account where you're contributing $50 a month, like literally this thick. No, okay, fine, this thick, but it's like literally about 25 pages. And that's, and like what I love actually when I registered with Equivesto is that, like, you really broke it down into such a simple way compared to like old school investment branches. So so I appreciated the process too at Equivesto. Do you have any other questions? Anybody?
I have a question.
Oh, yes, go ahead, Maya.
Right. So in terms of like choosing the companies, is there any guidelines to go by, or is it kind of like well simple where you have to do all of the research on your own and then make the decision as to whether or not you're going to invest in that certain stock or company?
I think that's a good question. From my perspective, and Zulani, you can add to this if you want, but from my perspective as an investor on this site, it'd be up to me to look at the companies and do my own analysis and evaluation. But what's really cool with things like Equivesto is that there was already a due diligence and a vetting that took place for them to be able to already be on the website. So that takes out the hardest part. So from there, it's just looking again at what looks good to you, what your values are, what interests you, where you see potential is, and then you can choose from there. but a lot of the grunt work was already taken out. So it's just a matter now of what speaks the most to you.
Absolutely. We like the campaign is just like the tip of the iceberg, because 3 months prior to the campaign, we actually had to vet every single person that was mentioned on, let's say, the pitch deck. So if the VP is mentioned, if the marketing coordinator is mentioned, if the founder is mentioned, of course, we have to vet them, and we have to also see that and verify that, you know, they went to this college, or, you know, they say that, like, we just have to check who they are and verify that. But we do that for you guys, of course.
Thank you.
Keep the questions coming if you have them. Don't be shy.
Hi, Melissa. This is Paige. Thank you so much for putting this all together. I have a question. I'm not too sure if you covered this or not, but let's just say I wanted to start up a VC fund. And I know you covered like the general partners, limited partners and stuff. Do I need to get that registered through OSC, or can I just have the fund and then present all of like the thesis and like deal flow and like the plan to the investors? Like, for example, I have some high net worth individuals in my circle, and they have money that they want to invest in projects and stuff. And it's like, well, you know, maybe we can create a fund. Like, so I don't know how that would be started.
Okay,
Does that make sense?
Yeah, for sure. And I do believe that the fund, like if you're gonna have like a VC fund, it does have to be registered with the appropriate regulatory bodies.
Right.
I can't name them off the top of my head. Like I literally know like 24 acronyms for all the regulatory bodies in Canada. However, for you, Paige, what I would recommend is putting together an angel syndicate, which is like a mini VC fund, right? So you get together like, you know, 3 to 20, depending on how big and wieldy you want to make the syndicate. You get together a bunch of people you know and that you trust, and that trust each other, and that you know can make the investments, like say minimum 5,000 each or more. Put them all together and create like an angel group, and then you can invest in projects together. And there's like a lead angel, and that might be you, for example, who will do most of the work, going out and sourcing the deals, which means you can bigger, say, percentage stake if you want. It's up to you and up to the other angels. And you do it that way because I'm not saying that way is a way of bypassing certain VC firm, but it's a really effective, like, quick way of getting into it with a group of people. And again, like the more barrier, right? Because the more investing power you have. So I would start with an angel group where it can be like an informal group of people who all decide to invest in projects together that have high potential once that you guys have done your due diligence. And then like you approach the founders, you have your lawyer ready to do up the paperwork for the terms of the investment, like how much ownership, etc.
Perfect.
And maybe
Thank you so much.
No problem. And maybe if you like, what I can do is send links to some really popular angel networks, angel groups, and syndicates here in Canada, so that you have examples, and so that you can like reach out to them, pick their brain if you want, and you can even maybe join theirs and see how it works, and then start your own. It's up to you. But I can include that in my follow-up links in the email that's going to go out.
Okay.
Play.
Thank you so much. Appreciate it.
You're welcome. Anybody more questions? Keep them coming. And again, it's 8:33. So again, anybody that has to hop off now, totally understand. I'll stay on for another, say, like until like 8:45, basically. Because I know we went a little bit later. So I'll stay on for 8:45, and then we can sign off. But that gives us 12 more minutes for any questions.
Hey Mel, it's Ileana.
Hello.
How's it going?
Good. How about you? I haven't seen you in ages.
I know. I just wanted to say thank you so much for the webinar. It was amazing, super insightful, and
Oh,
I
thank
really
you.
appreciate how you drove home all the particular points as to why it's important for all the ladies and people of color to get involved in this sort of thing.
Mm-hmm.
And, yeah, super interested, and just wanted to say thank you to yourself and Zulani.
Oh, you're welcome. Thank you so much.
All right, have a good night.
Oh, you too. Good night. All right. If there's no more questions, I don't know, unless Zulani have any closing.
Hi, Melissa.
Oh, yes. Hi, Goya. Goya!
Hi. Thank you so much for this. I've learned so much. You know, they always say knowledge is power.
Yes.
And I'm glad that I was able to
Me
join in.
too.
So thank you. A quick question to you is, what do you recommend based on all the financial resources I've kind of gone through?
Mhm.
They recommend that you pay off all your debt before you start investment.
Ooh.
Can you do both, or is it yeah? So what would you say, just to make sure that you're not overwhelming yourself or spreading yourself too thin?
That's such a good question. So here's me personally what I would recommend, and this is as like a financial advisor who's on her way to getting her certified financial planner designation, is that to make investments in venture capital, even in a crowd equity, an equity crowdfunding platform, remember that once you put money into that kind of investment, you can't take it out. You know, if you're like, oh no, like, like you need the money for an emergency, or you really want to go on vacation, like you don't have access to that money until some kind of, again, like ideally liquidity event happens. If it happens, you might lose the entire investment anyways. So keeping that in mind, I would recommend that the only debt you have is, like, say, is what's called good debt, right? So OSAP or your mortgage, right? Before you make investments into any kind of angel or VC or startup. Because again, if you need that money for anything, you can't get it back. Whereas if you just had money in stocks or mutual funds or index funds in the TFSA, then you can take the money out, right? And same even with your RSP. Like, you put money into your RSP, right, in something like liquid, like so mutual fund or stock. And liquid just means you can convert it to cash relatively quickly. But even with RSP, you can take the money out. It just gets added back to your income, and then you have to pay the taxes outstanding on it. So I would recommend you clear as much of your bad debt, so your credit card debt, as much as possible. And then number two also is that you have a steady source of income coming in that more than covers your expenses every month, including your, like, say, student loan and mortgage payments. So as long as you have that, like a solid job with, like, a solid income where you can afford to, invest $100, into, say, equity crowdfunding, and you have an emergency fund somewhere else, and you have very little consumer debt, then I'd say you're good to go. I hope that helps. Oh no,
Yeah, no, thank you so much. That was good.
welcome.
I'll definitely shoot you an email.
Okay,
Later.
perfect. Awesome.
Thank you.
You're welcome. That's a great question, by the way, a very important one. Anyone else? Okay, there we go. So Maya, she wrote in the chat. She said, once the investment is made, what happens next? What do we have to verify our equity? Oh, okay, that's interesting. So again, from my perspective, and then Zulani, you can add to this, but from my perspective, say on Equivesto, once you make the investment, like it is already documented in your account that you have like your certain ownership percentage, and from there, it's just a matter of you tracking like how the startup is doing, right? And you can, and I know as an investment in, like, as an angel investor or a limited partner, you get reports from the founder quarterly. So I'm not sure how it would work with Zulani if, like, they're sent out to everybody who invested on the crowdfund platform.
Absolutely. So the company will directly communicate with you, and also you can communicate with the company. They will leave like an email where their investors can reach out.
Okay, excellent.
You're accurate, everything you said.
Okay, awesome. I know, but the thing is like I know when I invest in VC funds, like I don't get any kind of like nice certificate. I just get like a document that has like that I guess has my term sheet, like my percentage that I own of the company, and like, well, how much I invested and what that translates to in terms of percentage ownership of the company. And I'm sure that once you do the investment on Equivesto, that information is in your profile on your account.
Yes, it is. On that note, yes, we have a dashboard, and you basically can see all of your investments in one secure digital location. So you don't have to go, if you invest in two companies and all, like you're going to have to be looking at two different places. Everything is just kind of in the platform.
Great. Any other questions? I see Lee's on here. Lee's like one of my IG friends. All right. Okay, so if there's no questions, that's totally fine. Hit me up on Instagram, Mel Talks Money, or email me, alan.melissa@gmail.com. I'll be happy to answer your questions. And Zulani, correct me if I'm wrong, but you will be sending out the replay. That's what we agreed to, right? Like you as in Equivesto?
Yeah.
Yeah,
Totally.
I'm going to be passing the video off to you guys.
Awesome.
Okay, great. Yeah, so look out for an email from Equivesto with the replay in it. And you know what, maybe I'll send you a separate email, like just thanking you all and for some resources that people mentioned in the Q&A section. All right, thanks everyone. Have a great evening.